Okay, so we have a question here which says, calculate the weighted average cost of capital from the following, using two different approaches to calculate the weighting factors. So as I said, first things first, the weighted average cost of capital is your overall cost of financing. Okay, overall cost of financing. Okay, businesses, if they need to finance their projects or buy new assets, it's either they can use equity financing where they sell shares, or they can use debt financing where they also sell debt. Okay, so these sources of finance, they're not for free. They have got costs attached to them. Okay, so the weighted average cost of capital combines both cost of equity and cost of debt financing to give you the overall cost of financing. That's from the business's perspective. From the investor's perspective, the shareholder, the one who buys shares, or the debt holder, the one who purchases debt from the business, it's the minimum return that's required to be given to the providers of financing of the business. Minimum return that needs to be given to the providers of finance. That's the shareholders and the lenders. So in this question here, we've got an extract of a balance sheet. We've got ordinary shares, all right, 20,000 ordinary shares. The book value of the ordinary shares is 50 pence. This should be Ngwe since we're using Kwacha, so I would say 50 Ngwe. I don't know why they put P, 50 Ngwe. Okay. Just like money, it's got an amount printed there, which is usually called, which we can call the face value or the nominal value, even shares. Okay. They have a face value and a nominal value. Okay. Then this is the value of ordinary shares in the business. According to the balance sheet, 10,000 kwacha. This was raised from selling these 20,000 shares. Okay. Yes. Then the market value, one kwacha 72, one kwacha 72 Ngwe per share. This is how much each share is going for on the Lusaka Securities Exchange. Okay. Then here we've got 9% preference shares, one kwacha nominal. Okay. We've also got preference shares. Their nominal value or the face value is one kwacha. This company raised 5,000 kwacha from selling these preference shares. Okay. Then these preference shares, they're selling at 98 Ngwe on the Securities Exchange. 98 Ngwe per one kwacha, just basically saying per one kwacha, meaning, because remember one share is valued at one kwacha, so it's 98 Ngwe per share basically. Okay. Long-term liabilities, 10% debentures. All right. Oh, this 9% here, I forgot. This 9% is the dividend rate for the preference shares. Okay. It's the dividend rate. Yes. Then here, 10% debentures. This is the interest rate of the debentures. All right. Raise 7,500. Each debenture is selling for one kwacha for Ngwe. Okay. Yes. This per one kwacha, this is the nominal value of the debentures. So the question says the interest rate on government bonds is 7.5% and the expected market rate of return is 20%. TBL PLC has an equity beta of 1.42. The corporation tax is 30%. Assume TBL PLC has a share value of 1.27 X dividend. X dividend means When you buy this share, it doesn't, you won't be paid any dividend that year. Okay. And has recently paid a dividend of 18 ngwe per share. The dividend growth is expected to be approximately 3% per annum into the foreseeable future. Both preference shares and debentures are redeemable at par in 5 years' time. Calculate the weighted average cost of capital using the market values as weighting factors. Okay. So remember this question. Since it's asking us the two different approaches for the weighting factors, so there's the market values and the book values. The book value, as I said, is according to the balance sheet. It's more historical. Okay. The market value represents what's on the stock exchange. It is current. Okay, colleagues. Book value, the past, what's on the balance sheet. Market value, the present, what's on the stock exchange. Okay. So we're going to start first with, let's see what I said with market values here. Okay. So these are the steps when you are solving questions for work. Step one. Okay. Get the market values of equity, ordinary shares, preference shares, and debt. Okay. Market values or book, because in this case, they want us also get book value, so you can also, or book values. So here we're starting with the market values here. Okay. So the market value of equity. Okay, we start with market value of equity. This MVE, this is the market value of equity. Or the ordinary shares. Okay. So it's just the number of shares times the market price. Okay. Number of shares times the market price. So in this question, we have the number of shares, 20,000. We have the market price, 1.72 kwacha. So we just multiply 20,000 times 1.72 kwacha. Okay. 20,000 multiplied by 1.72 kwacha, you get 34,400. Okay. So that's the value of the shares according to the stock market for this company. Okay. This 34,400 represents the value of ordinary shares according to the stock market. Any questions, colleagues? Yes. Now, take note. It's not always they're going to give you the number of shares. Okay. So, in case you're not given the number of shares, it's your ordinary share capital, money raised from shares. Ordinary share capital divided by the nominal value or the par value, the book value. All right. So here, if you say 10,000 divided by 0.5 kwacha, says 15 ngwe is 0.5 kwacha. 10,000 divided by 0.5, you're going to get 20,000. Okay, that will give you the number of shares. Okay, so just in case they are not given the number of shares blatantly, Then you can use that. Next, market value of the preference shares. So notice there's a trend among these things, okay? Market value of preference shares. Okay? Also, it's the number of preference shares times the market price. Okay? Number of preference shares times the market price. That's how this formula won't be given to you. Okay, so you need to remember them. Okay, number of shares times the market price. Okay, or if they haven't given number of preference shares, number of preference shares. They don't give you the number of preference shares, then you can use the preference share capital over the nominal value. So let's see in this question, they haven't given us the number of preference shares. Have you seen? Ordinary shares they gave us here. Preference shares they haven't. So the preference share capital, money raised from selling the preference shares, divided by the nominal value here, 1 kwacha. Okay, so you say 5,000 divided by 1 kwacha. Preference share capital divided by the par value, the nominal value, multiplied by the market price, 0.98. So 5,000 divided by 1,000 by 1, we have 5,000 preference shares. 5,000 times 0.98, you get 4,900. Okay. So this is the value of the preference shares according to the stock market. Okay. Not according to the balance sheet. All right. What's on the balance sheet and what's represented on the stock market is different. Okay. And these market values, they help you also value a company. Okay. If you want to value a company before you sell it, you can get find the market value of equity, market value of debt, market value of preference shares. Then when you add them all together, that's called the enterprise value of the company. Basically, that's the value of the company. So once you know the value of the company, then you can now decide, okay, how much should this company be sold for? Okay. Any questions before we go to the bonds now? Okay, so the market value of debt, it's the number of bonds or debentures, number of debentures. Yeah, what did they use? They said bonds, debentures. So yeah, number of debentures times the market price. So colleagues, have you seen the pattern here? It's the number of whatever you're dealing with times the market price. Okay. So here we haven't been given the number of debentures here. So we've only got the par value here, this 1 kwacha here, and the value of debt, the value of the debentures here. Okay, so to get the number of debentures this company has, you're going to say the value of the debentures divided by the par value of the debentures times the market price. So the value of the debentures is 7,500. Par value is 1 kwacha. Market price 1.04. So 7,500 divided by 1, 7,500. Multiplied by 1.04, we get 7,800. So this is the value of the debentures according to the stock market. Any questions? Hmm. Mhm. Any questions? Okay. So I usually advise doing this step whenever you're dealing with work. Okay. Calculate the weightages. Okay. Before, so that when you reach the formula, it's just a matter of just substituting. Okay. So here we can get the weightages. Okay. So weightages, we're just saying, okay, out of our total financing, what percentage is from ordinary shares, what percentage is from preference shares, and what percentage is from debentures. Okay. So the market, we use the market values for ordinary shares at 4,400 plus preference shares 4,900 plus debentures 7,800. So that 4 plus 4 9 plus 7 8 you get 47,100. Right. So now we get the weightages. Okay. So you're going to say 34,400 divided by 47,000. 47,100, you get 0.3. Okay. So ordinary shares represents 73% of the financing. That's what this weightage is just telling us. Okay. These percentages, okay, you hear this term capital structure. The capital structure just tells you how much financing comes from equity or debt. So here we can see 73% of the financing is from ordinary shares. And for preference shares, we'll say 4,900 divided by 47,100 gets 0.104. So 10.4% financing is coming from preference shares. Then debentures, 7,800 divided by 47,100, 0.166. Basically, 16.6% is coming from debentures. Okay. So 16.6% financing is coming from debt. Any questions, colleagues? Okay, so when we reach the formula now, we will just substitute these as you're going to see later on. Okay, yes. Step two. Okay, so step one for work questions, calculate market values or book values. Step two is now where you calculate costs. Calculate costs of equity and debt. Okay, now this is where it gets tricky. This is where usually they, you have to be careful with the wording on the question. Okay, remember, so we'll start with the cost of equity. All right, we're going to start with the cost of equity. So the cost of equity, as I said, there are two ways you can calculate it. All right, there's the capital asset pricing model, CAPM. Okay, this shows relationship between risk and return. Higher risk, higher return. And then you've got the dividend valuation growth model. This one is used to value shares. Okay. Finding it's used for finding these market values of this market value of these shares here. Okay. It's used to calculate them. Okay. Now, in our question, so I think there's a part A and a part B. So it seems part A, they're going to use capital asset pricing model. How I know we're using capital asset pricing model? This word here, equity beta here, which measures the riskiness of shares. Okay. An equity beta of greater than one, then the shares of that company are risky. You can make a loss, you can make a profit. Okay. Uh-huh. So once you see equity beta, especially this one equity beta, then things like interest rate on government bonds, which represents the risk-free rate. And if you see expected market return, okay, this is just on average, if you invest in securities in this Lusaka Stock Exchange, you expect a return of 20%. That's what expected market return is. If you see these things, colleagues, then you know you're using the capital asset pricing model. Are we clear on that part? Because this is where a lot of students get confused. So I don't know which one to use. I've underlined the terms which must look for. Are we okay with this? Any questions? So the capital asset so we're using the capital asset pricing module. Then in question part B, have you seen part B here? They've told us TBLPSC has a share value of 1.27 and has the shares. The riskier it is, the bigger the potential of profits. Okay, so if you're a risk taker, you would want to invest in that. But if you're a conservative investor and you see an equity beta is greater than one, you wouldn't want to invest there. Okay, madam? Yes. Then anything below one is more less risk. Okay. Less fluctuations in profits or in dividends. So it's more stable. So most of us, we are, how can I say, we're not risk takers. Okay. We are more conservative. So most of us, if we had a chance to go and invest in, if you're looking at shares to invest for a company, you would want one with a lower beta. Then as I was saying, part B, okay, when you see information, especially about, let's say, the growth rate of a dividend, the dividend growth rate is expected to be approximate. Okay, it means there you're using the dividend valuation growth model. Okay, even if you hear information about a dividend being paid, okay, then you know you're using the dividend valuation growth model. Okay, yes. So I believe in this question, um, this is part A and part B. Okay, because you can't have capital asset pricing model and dividend valuation growth model in the same question. Okay, so that's why I believe there's a part A and a part B there. Okay. Oh, it's already been indicated here. So part A ends here. Yes. All right. So We're using the capital asset pricing model for part A. And this is the formula for the capital asset pricing model. The risk-free rate, okay? This is the interest rate on government securities. Why is it risk-free? Because government is the one that prints money through the central bank. Okay. So if they run out of money to pay people, they can print new money to pay you. Or they can make new securities and sell them so that they pay you. Okay. That's the risk-free rate. Equity beta, I also said here 1.42. Expected market return 20%. Okay, just these three things. Have you seen? Risk-free rate plus equity beta, return on the market minus the risk-free rate. Now this return on market minus risk-free rate is also called equity premium. Equity premium is just the extra return you're getting if you choose any other investments that are not risk-free. Okay, you've got an option to choose. You can either invest in risk-free investments or you can invest in non-risk-free investments. So if you choose to invest in non-risk-free investments, expect an extra return. That's what we're calling the equity premium. Okay. Expect extra return because the name of the game here is the higher the risk, higher returns. Okay. Higher risk, higher returns. Lower risk, low returns. That's why you see the risk-free rate is relatively low there. It's 7.5%. Okay. But if you see the expected market return is 20%. Okay. So there is a discrepancy there. So that extra return that you get when you choose non-risk-free investments, the ones which are the shares and the bonds for the companies, then you expect an extra return. Are we okay with that, colleagues? Any questions before I move further? Now, for this one, I believe the formula, remember it. Sometimes they bring it. I've seen other papers where they show it, but I don't know if Dr. Kawe shows his. So, I would advise you remember it. So risk-free rate plus equity beta, open brackets, expected market return minus risk-free rate. So here, 7.5% plus 1.42, open brackets, 20 minus 7.5. You subtract, then you multiply 12.5, 1.42, 17.75. Then finally, you add 25.25. Any questions? Okay. Next is the cost of debt. Okay. The cost of debt. Now here, as I said, cost of debt also, you have to be careful. There are two variations. It's either you have redeemable debt or it's either you have irredeemable debt. So once you reach cost of debt, the next thing you have to find out now is the debt redeemable or is it irredeemable? So how to tell? If you look at the question in part A, they haven't mentioned any maturity of the debt or the preference shares. Or here it says, well, first let's focus on date. They haven't mentioned any date of maturity. But if you look in part B, say they've told you both preference shares and debentures are redeemable at par in 5 years' time. So we know in part A, since they haven't mentioned anything about maturity, so in part A, the debt is irredeemable. It means it doesn't mature. Once you purchase it, you just be receiving interest payments. Okay. Now I don't know really for how long. I don't know if you pass on, if the interest payments transfer to now your next generation. Okay. Or as long as the company stays around, I think. As long as the company stays around, I believe, yeah. So in part A, since there's no mention of maturity, we're dealing with irredeemable debt. So irredeemable debt, this is the formula. Okay. Cost of debt, the interest rate, 1 minus the tax rate over the market price. Okay. Now, colleagues, this 1 minus t, what it means is that as a company, when you take on debt, the money that you're going to be taxed reduces. Okay. The money that you're going to be taxed on reduces. That profit before tax. Okay, remember you've got profit before interest and tax. So now that when you take on debt, there's the interest payments you have to make. So those interest payments, they lower the profit before tax. Okay. So by lowering the profit before tax, we take it as you have saved on taxes. Okay. A company which doesn't take on debt will pay a higher tax than a company that takes on debt. I believe I illustrated that last time. Did I illustrate that last time? Okay, if you're not there, okay. Okay, for now, just remember a company that takes on debt is going to pay a lower tax than a company that doesn't take on debt. So this 1 minus t, it's saying that you're saving on some taxes. Okay. So here our interest rate is 10%, our tax rate is 30%. Convert it to 0.3. 1 minus 0.3, that is 0.7. Okay. 10% times 0.7, that is 7%. This 10%, if you want, we can also convert it into a decimal. Okay. Then 7%, yes, converted into a decimal, 0.07 divided by 1.04, got 0.06731, which is 6.73%. Any questions? Okay. Even preference shares, part A, they told us that the preference shares, we saw there's no maturity. There isn't any maturity. So they're also irredeemable. So if preference shares are irredeemable, this is the formula. The dividend for the preference shares divided by the market price. Right? Dividend of preference shares divided by the market price. So the dividend for each preference share is 9%. So 9% of 1 kwacha, that is 0.009. Okay, so 0.09 divided by the market price, PO, you get 0.00918. Multiply by 100, you get 9.18%. So that's the cost of preference shares. So once you're done with that, that's when now you calculate the weighted average cost of capital. Okay. So let me explain this formula here. So VE, market value of equity, over market value of equity plus market value of preference shares, market value of debt. Now this fraction here, we already did it in this table we did here. This table, we already did those tabulations. Okay. These tabulations are representing those fractions there in the formula here. Mhm. Yes, I'm recording. Okay, okay. So colleagues, these fractions here, we've already done them in this table here. These weightages as representing this. Okay. So put it like this. So it's each weightage times the cost. So it's the weightage of equity multiplied by the cost of equity. The weightage of debt multiplied by the cost of debt. The weightage of preference shares multiplied by the cost of preference shares. Okay. Yes. Each of the weightages we did. So these values 0.73 we substitute it here. 0.104 it will be substituted here. 0.166 will be substituted here. And then the costs of equity, cost of preference shares, cost of debt. Oh, and I forgot one thing. Wait. Here on the I is the interest payment. We have to get the interest payment, which is just the interest rate times the par value. So interest rate was 10%. The par value was 1 kwacha. Sorry, I misstepped. I stepped overlooked that. So 0.1 times 1 kwacha is 0.1. zero point 0.7 times 0.1. Zero point 0.07. Oh, you still get the same answer. 0.007. 0.0. So it still stays the same. Okay. Yes. Yes. So then market value of equity is 0.73 times cost of equity 25.5. Market value of the weightage of cost of the preference shares times the cost of preference shares and the weightage of debt multiplied by the cost of debt. So we get these values and we add them up, we get 20.57. Any questions? That is the weighted average cost of capital. Any questions, queries?